Juris Vodcast with Scott Pearce.
Glass-Steagall was enacted in 1933, shortly after Franklin Roosevelt took office. This important banking regulation law was repealed at the end of the Clinton years. The current problems with the American economy are dramatic, but they're not new. Thinking a little bit about the story of Glass-Steagall can give us some important ideas about how to build a stable and just financial system. It's true that the law of banking and securities is incredibly technical and arcane, but the basic ideas are not that complicated. The stock market crash of 1929 was the opening bell of the Great Depression, which didn't really end in America until the country started to mobilize for World War II. Obviously, there was no one single cause of the stock market crash and the bank failures that followed, but there was, and remains, a broad consensus that two big causes included loose credit and dishonest banking practices. Franklin Roosevelt came to power in the 1932 election with a mandate to regulate the banking and financial systems. The Securities and Exchange Commission was started at this time, and the Securities Act and the Securities Exchange Act were passed into law. These two laws, both of which are still alive and well, dealt with initial public offerings and with the secondary market for stock trading. Glass-Steagall was passed at about the same time as the Securities Act. Glass-Steagall set up a wall between banks that offer commercial banking services and those that are investment banking operations. Before Glass-Steagall, banks could both loan money to businesses and, at the same time, sell shares in these businesses to their investment clients. This was seen as an obvious financial conflict of interest. Glass-Steagall was strengthened in 1956 under President Eisenhower. The Bank Holding Company Act made it illegal for banks to underwrite insurance policies, although banks still could sell insurance. These laws were successful. They worked. But as the decades passed, the banks hungered for higher profits. In 1999, Congress passed the Gramm-Leach-Bliley Act, and President Clinton signed it into law. Gramm-Leach-Bliley repealed Glass-Steagall. Now the banks were allowed, once again, to combine investment and commercial banking under one roof. Now their agents were free to loan a lot of money on speculative ventures, knowing that they could sell these investments to their clients. Deregulation of the financial markets always has the same two consequences: concentrating wealth in fewer hands and economic chaos. The chaos is beginning. With luck, re-regulation will follow.
Juris Vodcast is a production of Nuclear Podcasting. Creative Commons Attribution Non-Commercial No Derivatives.